Okay, let's talk retirement. What's your biggest worry when you actually, sit down and think about it? Is it Social Security? That whole system feels a bit shaky these days, right? Or is it your 401k, making sure it's actually working for you with all the fees and market swings? Or maybe, just maybe, you're looking at the wild west of crypto investments, where things can change so fast. For a lot of us, figuring out how to have a secure future feels, well, uncertain. It's easy to just stick with what we've always heard, but what if some of that traditional advice isn't quite as solid as we thought, especially now with everything changing? Today, we're doing a deep dive into something pretty interesting. We're looking at the connections between seemingly opposite financial worlds. We're going to talk about Dave Ramsey, the super blunt, no nonsense finance guy, and bridge his advice to the world of crypto and Web3. I know, sounds kind of strange, right? Ramsey, who's all about being debt free and using cash, versus the crazy volatility of digital money. What we found is, well, the basic ideas he pushes, they're incredibly relevant, maybe even more relevant in this digital age. This isn't just about what to do, it's about understanding the why. We want to pull out those key bits of knowledge, give you a shortcut to being really well informed.
That's exactly it. And for this deep dive, we've really dug into a bunch of sources. We looked at some sharp analysis from places like Money Talks News, Hindustan Times, quite a few, actually. We've basically taken Ramsey's main warnings about those traditional retirement pillars, Social Security, the 401k, and we're translating them, translating those timeless ideas for today's world, especially if you're someone who's heavily into digital assets or even just thinking about it. Our mission here is pretty straightforward. We want to give you the perspective you need to make smart choices, choices that build real strength into your financial plan. We're going to show how these ideas about being financially careful apply everywhere. It doesn't matter if it's stocks and bonds or if it's Bitcoin and Ethereum. It's about seeing that, okay, the assets might look different, but the core principles of managing your money wisely, they don't change. So let's unpack this together. Hopefully you'll have some real aha moments along the way.
All right, let's start with a big one that causes a lot of anxiety, gets a lot of headlines: Social Security. You hear the worries, the arguments back and forth, but what does it actually mean for your retirement? Okay, let's unpack this. Dave Ramsey has this really stark warning. Some people might even say it sounds alarmist. He basically says you should think of Social Security like a life raft. A last resort, not the cruise ship you plan for your golden years. He's adamant that relying on it too much as your main income source, that's dangerous. Which is, well, a pretty bold statement, right? Challenges what a lot of people assume.
Oh, he's completely firm on that. And honestly, for some very compelling reasons. It's not just his opinion. What's interesting is his argument isn't just a gut feeling. It's based on real long-term demographic stuff and these funding shortfalls that are kind of looming. The main problem, like our sources point out, is this basic imbalance. We've got fewer people paying taxes into the system for every person who's retiring and collecting benefits. Think about the baby boomers, huge generation, all retiring now, living longer too. And birth rates have dropped. So fewer younger workers are supporting this growing group of retirees. It just puts a strain on the whole system. And it's only projected to get worse. We're actually approaching a critical point pretty soon. The number that really makes you sit up and pay attention, and honestly, every investor, every trader should be watching this, comes from the Social Security Administration itself. Their own projections say that as early as 2034, that's just over 10 years away, the trust funds could run out. Now, what does that actually mean? It doesn't mean Social Security just disappears overnight, but unless Congress makes some big changes, benefits could drop.
They could drop to about 80% of what's currently promised. Now stop and think about that. A 20% cut, what does that do to your retirement plan? If you budgeted for, say, $2,000 a month from Social Security, suddenly you're looking at $1,600. That $400 difference, it might not sound like a fortune each month, but stretch that over a 20 or 30-year retirement. That's a huge shortfall. We're talking tens, maybe hundreds of thousands of dollars. It could totally change your lifestyle. Forced cutbacks maybe mean working longer than you wanted. It's not just a number. It's a real potential lifestyle shift for millions.
Wow, yeah. That's a powerful way to put it. It's like you wouldn't build your dream house on a foundation you knew might shrink, right? Or develop a huge crack in a few years. You'd need other supports. Strong ones. Independent ones. Because that main structure, it might not hold up like you planned. You can't just, cross your fingers and hope someone else fixes the foundation later. You got to build those extra beams yourself, now, before the cracks even appear.
Exactly. So what's the takeaway for you listening right now? It's a huge wake-up call. A call to action, really. You need to reevaluate your own retirement income plans now. Be proactive. Recognize that you just can't assume Social Security will cover everything. Sure, it's meant as a safety net, but expecting it to be your main pillar or your only one,
That's a risky place to be. This means you've got to find and grow other income streams, streams that you control, not ones dependent on demographics or politics. Critically looking at how much you depend on Social Security. That's absolutely the first step to building a retirement plan that's truly secure and resilient.
Okay, so beyond Social Security, Ramsey also looks really closely at another sacred cow of retirement planning, the 401k. For ages, we've been told just put money in, set it up, forget about it, let it grow magically. It's like the bedrock for most working folks. But our sources show Ramsey's really worried about that passive approach. What are the blind spots here? What do most of us miss when we just trust the 401k?
Yeah, he hits hard on a few key problems with that standard set it and forget it 401k thinking. And these aren't small things. They can genuinely derail your retirement. First, there's just the issue of inconsistent contributions, or not contributing enough. Life happens, right? People change jobs, have medical bills, maybe high debt for a while, so they stop contributing, or cut back, thinking, oh, I'll catch up later, miss her. But those gaps, they seriously hurt the long-term compounding. That's where the real magic of retirement saving is. Like, think about a 25-year-old. If they miss just 2 years of maxing out their contributions early on, that could cost them over $100,000 by retirement. It's not just the dollars they didn't put in, it's the decades of growth those dollars didn't get. Compounding needs consistency. Any break is like a silent killer for your future money. Second, and this one's sneaky, but Ramsey is super passionate about exposing at high fees. We're talking about the expense ratios on the funds inside your 401k, admin fees, the plan charges, maybe even small trading fees. They're not always obvious, right? Buried in the fine print.
They might seem tiny, a fraction of a percent here, another fraction there, but over decades, these little percentages compound too, relentlessly, against you. A small 1% difference in fees might look like nothing, but the sources show over 30 years, that 1% could eat up maybe 30% of your potential gains. Think about that. If your account could have grown to $1 million, $300,000 might just vanish into fees. Gone. From your pocket to someone else's. Ramsey really pushes us to check these hidden costs because lots of people just assume their 401k is cheap, but they can vary wildly. And finally, there's something people often forget about. Planning how to take the money out. Poor withdrawal planning. Getting money in is one thing. Getting it out smartly, tax efficiently, that's a whole different challenge. People often don't get the rules around early withdrawals, which can mean big penalties, or they haven't thought about how to draw down the money in retirement. This can lead to surprise tax bills, running out of money too soon, or having to sell when the market's down.
If you don't have a clear plan for when and how you'll use those funds, thinking about required distributions, tax brackets, how long you might live, you could burn through your savings faster than you think. These are all real things that, like Ramsey points out, can absolutely wreck retirement plans. Turn what seems secure into something uncertain just because you ignored these details.
That really makes a strong case against just being passive, doesn't it? So, for you listening, it means you need to take a hard look at your own 401k habits. Don't just assume it's all good. Are you contributing consistently? Have you actually looked at the fees on your specific funds? Compared them? Do you even have a basic idea of how you'll take the money out someday? It's about shifting from just putting money aside to actively managing that money. Make it a real wealth building tool, not just a piggy bank. So if he's kind of skeptical about relying too much on Social Security, and he warns against just passively throwing money into a 401k, what does Dave Ramsey suggest? He's not just pointing out problems. He has a very clear step-by-step plan, a relentless set of alternatives he teaches. It's a strategy really built on financial independence, aggressively avoiding debt, and not relying on things you can't control. So what does that playbook actually look like?
Exactly right. His advice isn't don't save for retirement, it's how to save, strategically, proactively, on your own terms. And it's sequential. You do one step, then the next, his first step, the absolute foundation. Always, always put enough into your 401k to get the full employer match. That is, quite literally, free money, an instant guaranteed return, sometimes 50%, maybe even 100% on what you put in initially. Not taking it is just leaving money on the table, period. But interestingly, Ramsey sees this as maybe the only part of 401k he fully gets behind without hesitation. Why? Because it's guaranteed and immediate, unlike the uncertain returns and hidden fees often lurking inside the 401k itself. Okay, once you've got that match locked down, Ramsey's focus shifts dramatically. Priority number 2, eliminate debt. All of it. For him, debt, especially high-interest stuff like credit cards, personal loans, even car payments, is like an anchor dragging down your ability to build wealth. He pushes his debt snowball method, pay off the smallest debt first for that quick win, that psychological boost. Then take that payment amount and attack the next smallest debt, and so on. His logic is simple.
Every dollar you send to a lender is a dollar that's not working for you. It's not growing, not compounding for your future. Just imagine taking your average credit card payment, say $300 a month. and putting it into a Roth IRA instead. That's $3,600 a year plus decades of potential growth. Getting completely debt-free gives you incredible freedom, frees up huge amounts of cash flow you can then slam into investments instead of just paying off the past. It's non-negotiable in this plan. It sets the stage for real progress. After you're debt-free, the next crucial step is building a solid emergency fund, a really robust one. We're talking 3 to 6 months worth of essential living expenses. Saved up, liquid, easily accessible, like in a simple savings account. This fund, it's your financial shield. Life throws curveballs, right? Job loss, medical emergency, leaky roof. This fund protects you. It stops you from having to go back into debt when surprises hit. And crucially, it prevents you from having to sell your long-term investments at a bad time, like when the market's down. This point becomes super important when we connect this to crypto later. Selling crypto low in an emergency. Devastating.
Without this buffer, every unexpected cost could force you to raise your retirement savings, undoing years of hard work. Then finally, once that foundation is solid, match secure, debt gone, emergency fund full, to then his big recommendation for long-term growth kicks in. The Roth IRA. He is a huge fan of Roths, and for really good reasons that fit perfectly with his ideas about control and taxes. With a Roth, you put in money you've already paid taxes on, after-tax dollars. The magic happens later. All your earnings and your qualified withdrawals in retirement. Completely tax-free, assuming you meet the rules, like being over 59 and a half, account open 5 years, etc. That's a massive advantage compared to traditional IRAs or 401k, where you get a tax break now but pay taxes on everything you take out later. With traditional, you're basically saving money for Uncle Sam too. The Roth also has this unique flexibility that Ramsey really likes. Yes, it's for retirement, but you can take out your contributions, the money you put in, not the earnings, anytime, for any reason, tax-free and penalty-free. That gives you another layer of liquidity, almost like a backup to your emergency fund if things get really bad.
Makes it a super powerful tool. You get long-term tax-advantaged growth plus some near-term financial safety. It's especially good for younger folks who think they'll be in a higher tax bracket later, or anyone who just really values that predictable tax-free income in retirement.
So when you put it all together, it's clear this isn't just a random list of rules. It's a strategy, right? A disciplined sequence. It's designed to build this strong, solid financial base from the ground up. It's about empowering you, taking control, cutting risk by ditching debt, maximizing growth with tax advantages, and protecting yourself from surprises. It really flips the script from just passive saving to active, intentional financial management, making your money work harder for you, smarter for you. Okay, now this is where things get really interesting. This is where we connect the dots, moving from those traditional finance paths into the cutting edge of digital assets. We know a lot of crypto investors are out there building long-term wealth, mostly with digital assets, sometimes with this almost religious belief in decentralized finance. But here's the big question. Does Ramsey's traditional wisdom, all that focus on debt-free living and structured saving, does it even apply here? Or is crypto just too different? What's really fascinating, though, is what our sources suggest. There's this powerful, almost undeniable parallel. It turns out those core messages about financial discipline, they're totally universal. They work across asset classes.
That really is the beauty of it, isn't it? The power of these fundamental principles. Ramsey's core ideas, diversification, disciplined saving, careful planning, they are absolutely vital for crypto portfolios. You could even argue they're more vital. Given how volatile crypto is, how fast it changes, the regulations are still developing. It's a wilder ride. The stakes feel higher sometimes, and the unexpected can, well, become expected. Think about it this way. Ramsey warns you not to put all your faith in Social Security, right? Because it faces future problems, things outside your control. Well, there's a direct analogy for crypto investors. Relying only on one digital asset, say just Bitcoin or just Ethereum, without a real strategy. A strategy for maybe generating income from it, for handling the crazy price swings, for understanding the taxes involved. That's dangerously similar to over-relying on Social Security. You're basically putting all your eggs in one extremely volatile basket, a basket that can drop 50%, 80% in value, sometimes really fast. And the risks aren't just the market going down. It could be a bug in the code, a government crackdown, maybe the whole project just fails.
So in both cases, you see the same core risk, concentrating your entire financial future into one basket that might break or shrink or just not perform as you hoped. Social Security has its systemic risks, demographics, politics. Single crypto assets have market risks, tech risks, regulatory risks. The old saying holds true, don't put all your eggs in one basket. Having multiple approaches, multiple asset types, that builds resilience. It hedges your bets. It's about true security, not just chasing the biggest possible return from one thing.
Okay, so how does this actually work in the crypto world? How do we take Ramsey's principles and turn them into real strategies for people holding digital assets? Our sources actually give some pretty good examples, some case studies that make this really concrete. Shows how you can adapt that traditional wisdom.
Right, let's start with a really common crypto strategy, HODL, hold on for dear life. Now, holding long-term can be powerful, no doubt, especially in a new market like crypto. But Ramsey's message about diversification, it warns against how to dealing without balance. If someone keeps everything in just one coin, maybe only Bitcoin, only Ethereum, or worse, some small speculative altcoin, they're exposing themselves to what we could call retirement level volatility. Imagine your whole retirement fund dropping 70% or 80% in a bear market. That's happened to undiversified crypto holders. We've seen it. So Ramsey's call for balance applies directly. Diversify. It doesn't mean ditching Bitcoin if you believe in it. It means complementing it. Spread the risk. Maybe across different types of crypto assets. Some high-quality stablecoins, perhaps other strong Layer 1 blockchains. Or even look into ways to earn income within crypto itself, like staking or lending. Those income streams can generate yield, giving you a return that isn't just waiting for the price to go up. It builds a portfolio that can handle storms, not just bask in the sun. Okay, next up. Dollar cost averaging. DCA. This is a classic finance strategy.
Invest a fixed amount of money regularly, no matter the price. Smooths out your average cost over time. This lines up perfectly with Ramsey's emphasis on consistent 401k contributions. Just like steady contributions work wonders over decades, DCA into crypto or maybe diversified crypto funds can really help. It smooths out that crazy volatility. And maybe more importantly, it helps take the emotion out of it. Helps stop panic selling when the market tanks. Instead of trying to perfectly time the market, which is near impossible in crypto, DCA means you automatically buy more when prices are low and less when they're high. Build a stronger position over time, especially through those crypto winters. It's discipline over guesswork. And finally, let's touch on stablecoin yield strategies and how they might offer something like Roth-style benefits. But, and this is important, with some big differences you need to grasp. When we talk DeFi yield, we're talking decentralized finance. Finance on the blockchain, no traditional banks. Yield here often means lending your stablecoins out on a protocol and earning interest. Or maybe providing liquidity to a decentralized exchange. Think of it like this.
You deposit a pair of assets, say a stablecoin and ETH, into a pool. That lets others trade between them. You, as a liquidity provider, earn a cut of the trading fees. You're kind of acting like the bank yourself, earning fees. Now, the Roth-style benefit isn't about taxes. It's not legally tax-free like a Roth IRA. It's more about the flexibility. You can usually access your initial stablecoin contribution, your principal, without penalty. And there's the potential for tax-efficient compounding if you manage it right. You're generating passive income that can grow. And your base capital, the stablecoin, isn't bouncing around like Bitcoin. So it's a way to potentially get income from your crypto that's maybe less tied to wild price swings, more stable growth, maybe more predictable future income. Kind of echoes the stability and flexibility Ramsey likes in Roths. But it has its own risks. Smart contract risk bugs in the code could lose your money. Impermanent loss if you're providing liquidity and prices shift dramatically. And crucially, unlike a Roth, all your crypto income and gains are taxable. You need meticulous records, probably professional tax advice. It's definitely not as simple as a Roth IRA.
Wow. Okay, so the takeaway here for you, the listener, is really powerful. It's about thinking of these modern crypto strategies not as replacements for the old ways, but maybe as additions, as complements. It's about looking beyond just HODling volatile stuff, actively exploring how you can apply those proven principles, tax efficiency, income generation from traditional finance, but using these new digital tools. It really is a blend, isn't it? Old wisdom, new tech, working together to build a stronger financial future. Now, to really get a handle on these parallels, especially the risk versus reward part, we need to look at some numbers, some hard data. What do the charts actually tell us about how risky traditional investments are compared to crypto? Because, yeah, the principles might be the same, but the actual experience of investing is pretty different. Understanding the data is key.
Yeah, this is where the rubber meets the road and you see the stark differences. Let's talk historical ROI, return on investment. The S&P 500 index, what a lot of 401k track against, has delivered pretty consistent, though more modest, returns long term. Averagely 8-10% a year over decades. Sure, it has big drops sometimes, like 2008, down around 50%. But historically, it recovers. And compare that to Bitcoin and Ethereum. The returns have been, well, explosive at times. In bull markets, gains of hundreds, even thousands of percent in a year. Bitcoin went up over 1,300% in 2017 or 300% in 2020. Just massive numbers. But that raw return isn't the whole picture. We have to talk about risk-adjusted returns. Crypto's huge returns come with way higher volatility, way higher. So those bigger gains often mean taking on much bigger risks. Massive price swings, brutal downturns, long periods where prices go nowhere. It's not a smooth ride up, it's a roller coaster. Metrics like the Sharpe ratio try to measure return per unit of risk, and often traditional assets look better on that score over the long haul, even with lower raw gains. and that leads us to drawdown periods.
That's the drop from a peak price down to the bottom before it recovers. For the S&P 500, big drawdowns, maybe 20–30% happen, like that sharp drop in early 2020. But historically, they recover. For Bitcoin and Ethereum, drawdowns of 70%, 80%, even 90% have happened. Multiple times. Bitcoin dropped over 80% after its 2017 peak, over 70% after its 2021 peak. Now, what does that kind of drop mean for you, the investor, emotionally? Financially, can you watch your portfolio lose 70% of its value and still stick to the plan? Especially if that's your retirement money. It forces a really important question. What level of risk are you truly okay with for something as vital as retirement? It's not just about the potential upside, it's about your ability to handle the potential downside, the brutal downside sometimes.
Let's loop back to that Social Security warning we started with. That potential 20% cut by 2034, that's a real forecast. So if benefits might drop, what does that actually mean for our retirement income? And more importantly for this discussion, how does crypto fit into filling that potential gap? Is crypto the magic bullet for a Social Security shortfall? Or does it maybe just add another layer of uncertainty if you don't manage it right?
It's such a critical piece of the puzzle, and you absolutely need to plan for it proactively. Let's remember that forecast. Benefits potentially down to 80% by 2034. For lots of people, Social Security is a big chunk of what they expect to live on in retirement. If that chunk shrinks by a fifth, that creates a real tangible gap in their income. Think about your yearly expenses in retirement. If you expected Social Security to cover, say, $20,000, now maybe it only covers $16,000. That's a $4,000 gap you need to fill every year from someone else. Financial planners use these numbers all the time to model these potential shortfalls for clients. If your costs are X, your other income is Y, and Social Security was supposed to be Z, well, if Z is now 20% smaller, you have a specific gap to plug. This is where crypto's growth potential could theoretically be a factor. If you invested early, built up a good portfolio, the potential for big growth might help cover that gap, assuming it performs well and you have a plan to turn it into income. And this is where the planning gaps become really obvious if crypto is your only answer, or if you don't manage it strategically. That's a problem.
Just hoping your crypto moons enough to fill the gap without diversifying, without maybe generating some income from it, without knowing the tax rules. That's a high-stakes gamble, like buying a lottery ticket for your retirement. Crypto could be a powerful engine for growth, sure, but it needs to be part of a bigger plan. A plan that accounts for the volatility, the uncertainty, means knowing the difference between hoping for growth and having reliable income. So for you, listening, you've got to think about your personal risk here. Model your own retirement needs. Factor in that potential Social Security cut. Then ask, how will I cover that gap? Are current investments strong enough? Or do I need to adjust? Maybe add more diverse assets, more stable income sources to build a truly resilient plan.
Ramsey's focus on diversification and having an emergency fund. It's not just abstract advice, is it? It's like a practical shield. It builds resilience so you're not just constantly reacting to markets or life throwing you curveballs. It's like a financial airbag. How does this critical advice actually play out, both in traditional investing and, importantly, in crypto? And why is it just non-negotiable if you want real financial security?
This is where you really see the universal power of his ideas. Take diversification first. Let's imagine a hypothetical portfolio, maybe one like our sources suggest for balancing things out. Say, 50% crypto, 30% stocks, like an S&P 500 index fund, and 20% cash or bonds. That kind of diversified mix generally does much better over the long run, both for growth and stability, compared to going all in on crypto. Why? Because when crypto tanks and it does inflation, your stocks might hold steady or even go up. Your cash and bonds provide that stable anchor. It smooths out the ride. This mitigation strategy drastically cuts your overall portfolio volatility. It lessens the blow of those big crypto downturns on your total net worth. It's not about eliminating risk. It's about managing it smartly across different kinds of assets that react differently to market events. Makes the journey smoother, more predictable.
Right. So what does that mean practically? Diversity isn't about dodging all risk. Every investment has some. It's about managing it, spreading your bets. So a crash in one area doesn't wipe you out or make you panic, sell everything. It's about creating a less bumpy ride towards financial security, letting you stay invested for the long haul.
And that connects directly to emergency liquidity, having cash ready. A core Ramsey principle. Let's picture someone who's only invested in crypto. Then an emergency hits, job loss, big medical bill, whatever, what happens? Without an easily accessible emergency fund outside their crypto holdings, they might be forced to sell crypto to cover the costs. And what if the market is down? Imagine needing $10,000 and your Bitcoin, which was worth $50K last month, is now only worth $20 because of a crash. Selling then means locking in a massive loss, permanently, turning a temporary life crisis into a much bigger financial setback. Now compare that to someone who followed Ramsey's advice. They have that emergency fund, maybe cash in the bank, maybe even some stablecoin set aside purely for emergencies. They can handle the unexpected expense without touching their long-term investments. They don't have to sell low. They use the liquid fund, let their portfolio recover. This forces a critical question for you, listener. Is your money set up to protect you in a crisis? Can you get cash when you need it? Or could a crisis force you to make a bad situation worse by selling your long-term assets at the wrong time?
Having a dedicated emergency fund, traditional cash, maybe high-quality stable coins, it's non-negotiable in Ramsey's world. And honestly, it's a principle every single investor, no matter what they invest in, needs to embrace for true financial resilience.
Wow. We have really covered a lot today. We've taken this deep dive into Dave Ramsey's sometimes pretty blunt but always interesting wisdom. And we've seen just how relevant those core ideas are, not just for traditional finance, but right on the cutting edge with crypto and Web3. It's been fascinating, really, connecting these worlds that seem so different. It shows that the fundamental truths about money, they really do last.
Absolutely. We've really underlined how important active, intentional retirement planning is. You can't just hope for the best. It's about not relying too heavily on one single thing, whether that's Social Security for the traditional folks or maybe just one volatile crypto coin for the digital crowd. The power of diversification, spreading risk, and the absolute need for emergency cash, that cushion, these ideas work everywhere. At the end of the day, disciplined saving, careful planning, taking control of your own financial future, those are the cornerstones. They always have been, no matter how fancy the investments get.
So, as you navigate your own journey, whether you're building that traditional nest egg or maybe a crypto empire or probably a mix of both, think about this. What fundamental principles of building wealth do you believe will always hold true, no matter how much the financial world keeps changing?
Yeah, and building on that, what specific idea or maybe actionable step really stood out to you from our discussion today? Something that helps you think about your own financial security, especially with all these new investment options popping up. Your own reflection on this is super valuable.
Hey, if you found this breakdown useful and you want us to keep doing these deep dives, connecting traditional finance smarts with the crypto world, definitely help us out. Hit that like button, please subscribe to the channel, and ring that notification bell so you don't miss the next one. And leaving a comment. Engaging with the content, it honestly really helps us, boosts us in the algorithm, lets us know what you like, and allows us to keep making this kind of content for you. Thanks so much for diving deep with us today.